Someone sent me an Instagram message the other day, Vince.
Did they?
And they said, do you have an episode on listed investment trusts or LICs? Do you know what I said? No?
No, but I'll get that idiot Vince up and we'll talk about it.
I'll get Vince up and he can explain it. So, I mean, high-level listed investment companies, and I've got a bit of a presentation for those who are watching on YouTube, but you won't have to if you're in the car listening. High-level, if someone is new to the investing world and they've not heard the phrase LIC, L-I-C, what is a LIC? What's a LIC?
A LIC is what the label says, that it's a company that invests and is listed.
Right.
Now, what does that mean? Well, it's a company that you can buy its shares on the stock exchange.
So it's a public company?
It's a publicly listed company. Some of them are very big. And all it does is invest in other shares.
Right.
So it's a pooled portfolio of shares, which saves you trying to pick 20, 50, 100 shares to get your balanced or diversified portfolio.
So the listed investment companies in Australia, and there are only a handful of them.
There's a handful of material ones. There's 87 all up, by the way.
Gosh, yeah. But I mean, it's effectively a listed, active managed fund.
Yeah, absolutely. Yeah, that's a really good way of describing it. And it came about to solve a problem back in the 1920s and 30s, although they weren't actually listed back in the 20s or 30s. It was a way of letting individuals get a broad portfolio without having to go and buy 20, 50 shares. And they went to their stockbroker and they bought a share in the relevant company. They started being listed in the 60s, and it suffers from a few problems, and we'll probably come on to this, but which ETFs have largely solved.
Yeah.
The problem was that it was great for the fund manager because it was a fixed pool of capital, so they didn't have to worry about redemptions. It was tradable, so customers loved it. It paid commission, so stockbrokers loved it. And the downside was that when you wanted to sell it, you had to find someone else to buy your shares. And so the demand for the shares drove the price you got for them, not necessarily the value of the underlying portfolio. Then in the 50s or so in Australia, we got managed funds, which made sure that you could buy and sell at precisely what the underlying shares were worth, but they weren't listed. And the manager had to deal with redemption. So when you wanted your money back, they had to go and sell some shares to give you your money back. And then in the 80s or 90s, we got a best of both worlds, being the ETF, which allowed you to trade at the value of the underlying assets. You could buy them online.
The liquidity wasn't a problem.
And liquidity wasn't a problem. And the capital gains tax problem of people coming in and going out went away. So the ETF has largely superseded the technology of a LIC. It's probably a better tool. The LIC is a better tool for active portfolios. So if you want active, the LIC is probably a better structure than the ETF, and that's largely around disclosure. So LICs don't have to disclose their holdings every day.
Yeah.
And so it's hard to take, if you're running an ETF, it's hard to take a really active position because everyone can see what you're doing.
Yeah. I'll just start by, in the presentation we're going to step through, and you can see this if you are watching, we're going to talk about basically in some comparisons two of the main big LICs in Australia, Argo, the ticker is ARG, AFIC, the ticker is AFI, and then I've just kind of put a comparison of IOZ, which is the ASX 200 BlackRock Index ETF. A couple of things here. Argo started in 1946, AFIC 1936, and IOZ, that ETF was 2010, but the index has been around for as long as the ASX has been around effectively.
Except it wasn't called the ASX 200 in those days.
No, was it the
ASX,
All
Ordinaries.
The All Ordinaries, which was what, 30? No.
1800 at one point.
Yeah, really?
But it's been around since, well, as long as
the All Ords are 30 shares. Or am I?
That's the Dow.
The Dow. Oh, all right. We're going to...
Close but no cigar.
It's this is why you don't record with me before 11 a.m., Vince. But this episode, you know what, Vince? Today it is brought to you. You don't know this yet, but it is brought to you by Life Sherpa Invest. So I disclose I invest with Life Sherpa Invest. As do I. And it's effectively your company's portfolios that you use for your advice clients, but people can rock up with, start at $5,000 and put in, and they get the benefits of your IP, your portfolios, and set and forget. Keep pumping money, select their risk profile. It's pretty good.
It is. And their portfolio is largely of ETFs with some managed funds.
So there you go. You can Google Life Sherpa Invest. Otherwise, let's get into a podcast.
Let's go. Let's podcast.
All right. Welcome, Jess Brady, Financially Fierce podcast. You're joining me today on the show, so welcome back.
Thanks. It's nice to be in your new fancy studio.
I know, it's great, isn't it?
Yeah, it is great.
Jess has a podcast, Financially Fierce. We produce it for her. I've got no say over the content. She does it all. So if you love it, give her credit. If you hate it, give her the discredit. But yeah, we just wanted to provide more options for listeners, and lots of you listen to the Financially Fierce podcast.
Yeah, and thank you. And we've just turned 1.
Ooh.
Yeah.
Wild.
I know, wild. It's been great.
Yeah. Hey, I haven't talked about this for a while. People love my rants when I talk about the chess versus non-chess debate. There is a question here, also anonymous. Chess versus custodian for tax reporting. Hi all. Looking to DCA, that's dollar cost average, into a couple of ETFs long-term with potential small sells here and there. Why are we doing potential small sells here and there? Anyway, I'm wondering which model, chess or custodian, would be the simplest when it comes to tax report. Custodian, next question. Let's move on. I've bought a few individual stocks, chess sponsored, in the past and always dreaded tax time having to deal with buy-sell reconciliation, especially when making multiple buy-sells of the same stock through DCAing and offloading. I believe both chess and custodian models have different reporting methods, and I'm wondering if one is simpler than the other. Any insight and recommendation would be appreciated. Cheers. Do you want to go first on your views on this, or do you want me to keep on this rampage?
Oh, I like you on a rant. Go on a rant and then I'll add my bits.
Okay. Children, gather around. You've got to understand, number one, this question has said there's different reporting methods. When you've got a broker account, in theory, there's no quote-unquote reporting. You get a statement or whatever on this many shares, this company. If you sell, off, blah, blah, blah. I'll step back for those new at home. CHESS is the ASX clearing house electronic subscriber system. Probably got that wrong, but sub-register system, whatever it is.
Yeah.
That's annoying me.
Are you going to talk about HINs?
Yeah, I will, but I just had a total mind blank.
Oh, you could have said anything and I would have gone, yeah, it sounds about right.
Yeah, I think I was right, yeah. Clearinghouse electronic sub-register system, whatever. So basically that's the register on the ASX of what parcels of shares have been traded and where those shares are sitting. Each person who buys shares or each entity has what they call a HIN, holder identification number, and effectively if I open a new brokerage account, that broker is what they call